So, where do we start? I mean, I got to know you guys. I don't know if we really know each other. So I'll tell you a quick little, give you a little bit of background. I started I guess you call it my career as a college pastor. I was kind of did full time vocational ministry for about 6 years. And the reason I share that with you, I mean, I never thought I would do anything else. I loved it. My wife and I started buying real estate about 4 years into that. Bought our first duplex, and then we, bought our first apartment building and started syndicating deals. And I just learned, I think that I was very entrepreneurial. Like I didn't know what that was at the time. I just was like and so that really helped us realize like I am very entrepreneurial. And but anyways, the other reason I share that with you is I feel like in acquisition and marketing and what we're going to be talking about today, like the thing that makes me really good, or the thing that makes me really good and I think gives me an edge in this space. I learned all of it during doing college ministry
Yeah.
because it just was such a fun time. I was a young uh, country boy from South Carolina doing ministry, evangelism, outreach on one of the most secular colleges in the country, if not in the world. I mean, San Diego State University, and so it was all about like, how do we get attention? How do we build trust? How do we, we're starting from scratch. I mean, so we just did like the most craziest, wild stuff. It was really fun. And so I feel like all the things I do today, of just trying to figure out how we get attention and how we acquire new investors, I'm like, I kind of I learned it all in doing college ministry. So it's really, really fun. So, um,
Do you have any crazy stories from ministry?
oh gosh, bro. I mean, we could talk the whole talk.
You say that first time. I'm just curious because
Oh
I
yeah,
haven't.
man. I mean, especially at San Diego State University. I mean, just from the things we did versus the people I met with. I don't know what you want to talk about, but like I just telling the story on the podcast the other day. We did this slip and slide event where I just brought a huge tarp out in the middle of campus, and I because I was doing fraternity ministry, I was like the fraternity row was like on campus, and so I took a hose from the fraternity and stretched it all the way across the campus, not all the way across campus, but like across a pretty good chunk of the campus, and there was a bike path. And I just remember this skateboarder coming down the bike path, and it was like I thought to myself, "Oh gosh, I should have put a sign up that I had this hose stretched across the bike path." And he hit this hose and like literally went flying. That was so wild. So there's things like that from like the stuff we tried was crazy, but yeah, like student stories, so many. Anyways, so what I want to talk about today is not necessarily paid ads because I thought about it. It's like most people are not going to want to leave here and do paid ads. I really want to talk about acquisition, and I think the thing that I've learned first 7 years, first 6 years, first five. I mean, I just didn't. You're doing everything, but you don't really know what you're doing, right? It's like how do you just get attention? How do you acquire at all costs? But like you're just kind of like for me, anyways, and I think anyone kind of coming into business, it's not like I mean there are lots of good books out now, but but what do you like? You don't know really what to read, or there's no like blueprint for how to grow most of the time. But I feel like the thing that I've figured out in the last 2 years is I know now what the levers are that drive growth. And not just in this business, but I think in business in general. And I think that's what I want to go talk about today when it comes to acquisition is once you understand the levers, then at least you now know what to focus on. Not to say I'm good at those levers today, but at least I know now and I'll spend the rest of my career getting better at how to kind of pull and move those levers. And so that's really what this talk is more about is understanding acquisition and then just it's not really a talk, it's a workshop together. I want to hear from you guys too. And then we can yeah, and then that will help you if you want to go into paid ads or whatever acquisition strategy you want to, then you'll know the levers. So this is really about the growth formula and talking about growth. So growth equals acquisition times, anybody know what the second word might be? Acquisition times what equals growth? Any guesses? Acquisition times, what do you think it would be? You're a marketer. What would you say?
Either I would say it's either dollar amount or what is acquisition a number?
No, acquisition is just in general, like the two things you should be focused on. It's an A word, if that gives you a hint. The word I had in mind was attention. So acquisition times attention equals growth. And I think that's really, I mean, again, I came up with this, so I don't know if that's right or not, but it kind of made sense as I was thinking about like what are the two things that really help us like if from a growth strategy, what are you always doing? You're always trying to figure out how do I acquire and acquire more effectively, and then how do I keep how do I keep attention with the folks that I've acquired, right? And that really is growth. That equals growth. So acquisition times attention equals growth. So part one, there's only 3 ways to grow a capital raising business. So this is it. Like truly, guys, these are the only 3 things. There's only 3 ways to grow your capital raising business. Everything and every strategy will fall under one of these 3 points. So the first one is increase the number of investors. Number 2 is to increase the what per investor?
Investment amount.
Yep, investment amount is the second one. And then the third is increase what? The
number of investments.
Yeah, I call it frequency of investments. Yeah, but number of investments is the same thing. Exactly right. So everything falls under these 3 things. These are only the 3 ways to grow your business. Don't think of these so much as like a linear thing. Like these really are a circular path, meaning like you're always going to be doing all 3 of these things. Now you may emphasize one of these at different parts of your business. Like for example, in the beginning of your business, you're not really worried about frequency as much as you are number of investors, right? Like you have to go increase your number of investors. But at some point, like kind of where Aspen is, I mean, we're definitely still acquiring new number of investors, but the amount per investor and the frequency in which those investors invest is very, very important, right? Maybe more important, more paramount, because I think it's easier to grow, right? Like we have 850 investors. Like, could we get to $1 billion with 850? Probably not, but I don't think we need to 10x our investor base to get to $1 billion, right? It's going to probably come more from how do we make those investors invest more, and how do we get them to invest more over time. So that's that. Increase the investment amount. Here's what I'd say, guys: the easiest way to raise more money, and I think I've been kind of telling everyone this today. I truly believe that you should leave tomorrow and double your minimum. Like that's the easiest way to raise more money is just tomorrow, whatever your minimum is, double it. And just see, because the reality is when you double your minimum it's not like in your PPM, there's no rule to being able to not allow people that can't reach their minimum. Like meaning if your minimum's at 50 today and you raise it to 100, can you still allow people to invest at 50? Sure, but if you guys been in this business a while, like most people just will kind of do whatever the minimum is. Right. And so it's so true. Like we've seen this over and over. And those who can't reach the minimum will then say, hey, I can't really do that, but could you take, right? And then you have the discretion to say yes or no. And typically that's going to be higher than your other minimum because at least you've anchored at a higher. The other thing too is like, I'll tell you the story. It was a couple of years ago, I was sitting with a buddy and we were talking about like our investment, like our like what's your average investment amount right now? And at the time for me, it was like 70 grand. And I was like, what's yours? He's like, 30. I'm like, what's your minimum? He said, 50. I said, well, how can your average investment amount be lower than your minimum? He's like, I don't know. It's a good question. And I was like, well, tell me about your process. Like what's happening in your sales cycle? He's like, well, I have a young guy that takes my sales calls. I'm like, okay, I know what's happening. He's like, what do you mean? I was like, well, here's what's happening. I was like, you can go check this. If a young guy, 20-something years old, is taking your sales calls, here's what's going on. He's getting on the call with a high net worth investor or an investor, and he's having a great conversation, and he's getting to the point where, the investor asks, well, what's your minimum, right? You guys get that question a lot. And the young guy's saying, it's $50,000, but, right, we could probably take less. And why is he doing that? Because for a 25-year-old kid who's never seen $50,000, that's a heck of a lot of money. And so most of the time when we start this, we set our minimum at what we think is a lot of money, $50,000, $100,000, $150,000. Well, I mean, I've been in investor meetings where these guys don't even get out their checkbooks for less than $1 million, right? And wouldn't even consider an investment that had a $50,000 investment minimum because that looks not like a good investment to them, right? What's the exclusivity of a deal where you can get in at $50,000? It's not very good. And so I would just say like, investment, like one of the ways to increase his investment amount is raise your minimum. The other thing we've done really well with Aspen, it's kind of become standard now for all of our funds, is we have a $250,000 share class. So we have a fund manager share class at $1 million. That's how like our fund managers get paid, is the carve out from the bonus there. But then our next one down is 250, and it's become almost standard for us because if like for example in our oil and gas fund, our minimum is 150. Well, to get the next step up in share class is 250. So they're already coming in at 150, and just the bump in promote from 150 to 250. For example, in Fund 6, we had 8 people over $200,000. In Fund 7, we have over 35 people investing to date $250,000. Individual people doing $250,000 or more. And I would just say it's a lot more fun as a capital raiser to count in 250. You get to $1 million a lot faster, okay? Like a lot faster. I'd have to look at our share classes, but it's higher promote. So like instead of 70-30, I think it's 80-20 on that, and then the fees go down as well. So our fee structure changes and our promote changes. So they get a bigger piece of the pie in most cases. So what are you willing to trade? What are you willing to give up in profit to go get a bigger investment amount? And so that's a great strategy. It's like having share classes to incentivize larger investment amount. We do it on every fund now, and we just did it on our land fund, and it worked the same way. Like it's $100,000 minimum, but we're like, should we do a 250 share class? And I was like, yes, because there's going to be people who are going to see that and be like, I want something more, right? And it's not that much more, but it helps. And so even if you want to keep your minimum at 100 or 50 or whatever, having another share class to encourage larger investors to go get that is really significant. It's helped us raise a lot more money. So increase the investment amount. Guys, there's a sheet here if you want it. We're talking about the growth formula. Growth equals acquisition times attention. So there's only 3 ways to grow a capital raising business. Number 1 is increase the number of investors. Number 2 is increase the investment amount per investor. And then number 3, increase the frequency of investments. And so, I think about the Aspen story. They spent 10 years doing one thing, which was a mortgage note debt fund, right? That's paid people 9% every month for 12 years at this point. And I don't know where they were at before being started, but maybe 30 million of equity. Today we're at 300, and that was only really been in the last 5 or 6 years. And so the hockey stick was when they went from 1 offering to now like 5 offerings, right? It's because if someone comes in, and they have $1 million net, or let's say $10 million net worth. I mean, the reality is like if you only have 1 offering, or you're one vertical, they don't want to put all their money in multifamily, right? Like it's just the reality. And so we had an investor, who's been listening to our podcast for 2 years, call in this week, and they put $1 million with us, but they put it in 4 deals, right? And so they probably wouldn't put $1 million in oil and gas, but they put 500 in oil and gas, 150 into this, 200 into this. And so we're able to get a bigger piece of their allocation by having multiple offerings. You think about it, it's like in the acquisitions in the world, from an acquisition standpoint, the hardest part about acquisitions is what? What would you say the hardest part about acquisitions is? No, from an investor standpoint, acquiring new investors. Yeah.
Trust.
Exactly. Trust is the hardest part. Once you have trust, everything else is pretty easy. It's just finding good deals at that point, right? So if you've already done the hardest part with your investors, which is building trust, why not? And you're not, why not offering them something else, right? So I talk to a lot of lead sponsors of who are in multifamily right now. I'm like, dude, you're not making a lot of, you're not, even if you're doing 3 deals a year right now, you're crushing it, But I'm like, why not have something else that you can offer them, right? Like think about oil and gas, or think about an income or a debt fund, right? That can pay you recurring. And so if there's any way that Aspen could serve, this group is, talk to us about things that you're not doing, right? We have industrial, we have oil and gas, we have private credit, that, most of those will pay on a recurring basis on the money that you raise. And so those are just different ways to increase the frequency of investments, is by doing more offerings and doing diverse offerings.
Well, Mike said that if we raise enough, we could go to Bob's house.
Yeah, that's right. Yeah, we do a top performer event. He was at that's why Mike's also looks like this, because he broke his collarbone when we were up there. He didn't know about that. Yeah, he's been in a sling for the last month. Again, I just want to emphasize like these. You're always doing all of these at different parts of the business, and so I got some questions here on the bag you can look at later, but it will help you just kind of determine like which of these maybe am I underemphasized on, and which of these maybe have I overemphasized, and to really think about because when we think about growing, most of the time we're like, I just got to go get new investors, more investors, more investors. I'm like, more investors is maybe not. That's the hardest thing to do on this list. The easier ones to do, and the more seasoned your business becomes, it's actually easier, and you'll grow faster by doing the second two. But no, we're also even Aspen, like we're constantly trying to acquire new investors. So let's move on.
Can I ask a quick question?
Uh-huh.
And maybe get group input on this. So our minimum investment has generally been $100,000. We'll do friends and family 50, but we have really a bifurcated investor profile, right? We have the high net worth, ultra high net worth who can throw in $100,000 to $500,000 a deal. They know, like, trust us, so it's just they're very valuable. But then we have the SDIRA professionals, 30s and 40s. 100,000 for one project is, maybe they're 5 to 1.5 million net worth, so it's a reasonable part of the portfolio.
Right.
Have you guys had this where maybe dropping it down to 50, you can have them participate in more deals, get more predictable, capital funnel, and also help them diversify a bit, so if one deal doesn't perform as well, they're not hating you. Or you're just sitting there just kind of shoot yourself in the foot. Now, instead of raising $1 million on 10 guys, you're raising $500K.
I mean, I think it's fine. I think, to be honest with you, I think it's the wrong question, only because those guys are a tough avatar to build a business around because they only can invest $50,000. So part of raising your minimum is like attracting higher net worth people that have more money to invest. So in some ways, it's like, I think that's fine, but it might be the wrong question to be asking because why build the business around them in the first place?
Larger pool.
So future value.
Yeah.
True. There's a pretty freaking big pool of people who are worth $5 million or more as well.
Yeah.
So I was shocked. Post Investment Group.
Yeah.
So I got on the investor list, and they only take accredited investors. However, there's no minimum. Like, you can invest as low as you want. And so I asked him, I was like, why do you do that? Like, I was like, so you saying I can invest 1,000? He's like, yeah, whatever is the lowest you want. And it's all for customer acquisition.
Yeah.
They already know you're an accredited
Yeah.
investor, because otherwise you can't get to the deal.
Yeah.
Tim, who's this?
Post.
Jason
POST.
Post. Jason Post?
Yes.
Okay.
Yeah.
That's really interesting.
Yeah. I
I've
was
actually never heard
shocked.
that before. That's news to me.
That's pretty wild.
Yeah.
That's really expensive, actually, especially if they're only doing accredited. They're doing mostly 506Bs, I would assume, because they do a lot of affordable deals. But the cost for Blue Sky filings must be absurd.
Yeah. Honestly, that makes
Yeah.
no sense.
Yeah. I was really shocked. Man.
Like, trust me, don't do that. Like, it just doesn't make sense. Like, and I'll go into why it doesn't make sense here in a minute because, but I mean, maybe I'm not saying it doesn't make sense. Maybe they have a strategy behind it and they're going for a second investment, but that's,
It's kind of a gimmick.
it's kind of weird.
Investors aren't gonna waste their
Yeah.
time funding K1
Yeah.
rating less than 100K.
Yeah.
So I don't know, man. I think that's fine. I think that would really serve those people. So I think that would be nice of you to do. I think that's probably the right strategy for those guys. But I still think you could set your minimum. It's at 100 and say, hey, I can't. That's a lot for me right now. Here's another thing you could do to go back to increase number of investors. Hey, our minimum is $100,000, and we try and stick to that. However, I understand your situation. Do you have a buddy that you could bring in to help meet the minimum of $100,000 and make this worth it to both of us?
Yeah.
In that way, they're getting to $100,000, but they're bringing now.
That's a built-in referral.
Now you did them a favor, and they gave you a referral. So it's like make a rule. Hey, yes, but you need a buddy. You need a buddy plan.
So when you're drafting your PPM, you're just doing it at the lower investment amount? but then you publish that you have a higher investment amount.
You
No.
on this, you put in a clause that managers have discretion to waive
Yeah.
loans.
Gotcha.
I would put in the PPM like
The higher.
put in the higher, and then you have discretion to waive that for sure.
Well, I think it is a valid point, one I didn't really think about, but yeah, I think about my 50K investors, they all could have invested more.
Yeah.
All of them.
Yeah.
They just invested 50 because
Yeah.
it was the minimum.
Yeah.
It's kind of like testing the water.
Right. 100%. And I mean, here's the thing, guys. Like we've seen this. Like it's that Pareto principle. It's 80. I mean, truly, most of the capital we raise are coming from 20% of our investors, right? I mean, it's like, yes, that smaller pool is bigger, but it's a heck of a lot easier, man. If you have people who, and we got guys. I think I looked the other day. We have over 80 people with Aspen that have over $1 million with us. So that's a big pool that can continue to invest a lot more, right? And that's not one investment. So they came in and they've continued to put more and more in, right? Because they can. So this is going to be really key. So this is part two. What is one investor worth to you? So earlier I talked about levers, and one of the things that I think I've realized over the last couple of years is like, what are the levers that really matter? And so, one of those levers is just cost of acquisition. And so, in any business, but especially in this business, is he or she who can spend the most wins. That's pretty much business, right? In marketing, I mean, whoever can spend the most wins. And so, you either do that with venture capital and you're losing from the beginning, or none of us are probably venture capital back. We have to figure out how we lower our cost of acquisition, or do really profitable deals where we can spend more to acquire. Right. So this is a diagnostic for you to ask, and this will be helpful as you think about acquiring, is what is one investor worth to you right now? So we think about your product, whatever you're in, and just do the math. So if 100, and just do this on, I typically do this on like whenever, and this is helpful for me because when I'm thinking about acquisition across multiple channels, our average investment amount is like 130. So I typically do my math in my head on 100 grand. So on $100,000, if I go spend money in this channel, and I get one investor, $100,000, how much is that gonna earn us in the first year? So that's something for you guys to write down. In the first year, what is one investor worth to you over 12 months? Does anyone know what that number is on your product? What would it be for you? Yeah. Yeah, with your fees and stuff.
Yeah. Average investor is $73,000. So yeah, the number's probably for
$5,000. Yeah, that's pretty good. It's pretty good. So 5K. So then write down 5K, and then so over the lifetime, and then how much is that investor worth to you over 5 years from that one investment, right? So that's on the first 12 months from fees. So then what do you make on the back end, promote, et cetera? So for in my example, private credit fund is one of our deals. One investor, $100,000 is worth $4,000 for us in the first year. So over 5 years, 60, I wrote down 20 grand because I just times it by 5. But the reality is I put plus ... because it's an income fund. So if someone invests 100 grand, we write them a check in 90 days. Well, what do you think they're going to do before the end of the year? They're very likely 1 in 2 people are going to reinvest. So then that client is not worth 4 grand. Now they're worth 8 grand. And now because we have frequency of investments, we have diversity of offerings, they also, over the course of that 5 years, will probably invest another 3 to 5 to maybe 8 times. So what is our lifetime value over a 5-year period on one investor? We don't really know, to be honest with you. So what we're benchmark, and I would say we're probably willing to spend more than this, but what we're willing to spend to acquire an investor today is $3,000. So that's what we are willing to spend to acquire one $100,000 investor. So that just allows me, like when I'm looking at platforms where people want me to sponsor or do stuff, it's like, I just like, okay, well, can I realistically acquire, if it's $10,000, I just do the math in my head. How much money do I need to be able to make from this in order to make my money back? And if it doesn't beat what I'm already doing, then I don't do it. Right? And that's it. That's the whole game. That's pretty much what I spend my day thinking and doing. It's like, where are other places to go spend money, and how do we make what we're doing better? Like, that's pretty much what I do all day long. So that's really, really helpful. Really, like you in order to grow and grow effectively, you need to know those numbers. And feel free to stop me. I want to kind of get through this, and then we can workshop together. We can talk together. So stop me at any point. All right, but I'm gonna go down to part 3. Yeah.
Y'all ever done the exercise of, because I gotta presume that your database is many thousands probably.
Mhm.
Is it tens of thousands?
Like a 20,000 person.
20,000?
Yeah.
And 800 are investors?
850. Yeah.
850. So one in every not quite free investors or subscribers are investors.
No, it's way more than that. 8.
Forgive me,
Yeah.
20,000.
I don't know the math.
One in every
12.
every 20, 21
Yeah.
investors.
Yeah.
Is that a metric that you guys look at?
No, I don't care about that. Just because. No, I mean, not really, because I don't even know what that list is, to be honest with you, man. I don't even know where that list was before me. So, a better metric would be like, how much is it costing to get someone on the phone?
Someone on the phone, someone subscribing.
That'd be a better cost. A better metric is, how much does it cost? Like, if you're going to run Facebook ads on a lead magnet, how much, the metrics I would measure is, what's your cost of acquisition to get that person on the email list? And then how much, you can tag that person, and then down the funnel would be, how much is it costing over a span of time to get that person on the phone?
You guys have luck with Instagram ads?
I'll go over my numbers here in a minute on Facebook.
I see you on there, and it's well done. There's plenty of sloppiness.
Yeah.
That's out there though. So I wonder what
Yeah.
your offices would say about crowded
Yeah.
ads.
Yeah, I mean, I can give you, so I'll go down our acquisition costs. So dollar cost per investor. So this is really key, right? So this is just helpful for you to just kind of like, you need to know these numbers, right? So I'll give you our example, but this is for you to think through. So what is your dollar cost per investor? And again, once you know how much you can spend, so if I'm willing to spend $3,000, okay, it would be probably good to know, well, how much am I spending right now to acquire an investor? So dollar cost per investor. So what, just look over the last 4 months. So I took our numbers from the beginning of the year. What's your total marketing or sales spend since January? So in this, think about this, like you went to a conference, you had to buy a plane ticket, and a hotel room, and a conference ticket. Like, if that was a marketing strategy for you, that would be here, right? And then I would say, okay, I went to that conference and I spent 12 grand to do this conference. Going to conferences are expensive, it's like, that's why we don't go to a lot of conferences anymore, because I'd rather spend the money elsewhere. But like, I went to this conference, spent $6,000 in total, and I had 2 new investors from that. So then that means your cost per investor would be $3,000, right? If that's what happened. So for us, since January, we spent $31,509 on Facebook. We acquired $31,509 in total.
Year to date, okay, sorry.
Year to date, we spent $31,000, and we've acquired 4 investors since the beginning of the year. So that means our cost per investor so far for the quarter was $7,877. Now you might be thinking, that's almost double. That's more than double than what you said that you were willing to spend. However, our total dollars invested from those investors is $787,000. So our cost of capital right now is 1%. Just on those dollars. And then you also have to think, like, I just took a snapshot, meaning I'm just looking at what we spent and what we closed in this quarter. That doesn't take into account the investors we brought in this quarter. We're having conversations that, will likely close in the following quarters, right? So that will get better over time. The other thing, and here's why I don't really recommend Facebook for most people, and especially for most people at this conference, is like, if you're trying to spend money on Facebook right now on multifamily, friggin' forget about it.
Crowded.
Saturated.
Won't work. You're gonna get crushed. Not gonna work. Don't do it. The reason this is working for us is because we're doing oil and gas. So I spent 6 months talking about private credit and trying to sell a 11 to 13% return. Crushed us. I mean, like crazy, like probably 15% cost of capital. I could blend all of the money I've spent over the last 9 months, and I think my cost of capital today is at 4% because of the oil and gas offering. Because of the last 4 months, it's been 1%. Like 1% that's really freaking good, right? On anything. So I think the key to Facebook is you kind of have to have a unicorn offering that is just like, 25, 30, it just has to stand out. And I don't think it has anything to do with me being good at running running marketing ads. I think it has a lot more to do with a good offering.
After Facebook, do you have a preferred platform that does well for you?
I mean, referrals is
Well,
best.
I mean, Facebook, everybody knows it's a massive player in the ad space.
Yeah.
What would be like the next cheapest alternative?
Well, what I'm about to do in Q2 is I'm going to put a lot of money towards newsletters.
Mm-hmm.
There's a lot of good newsletters out there that I think we can acquire pretty affordably. Just what the sponsorship package is. It's already a captive audience, so I've already kind of got 4 or 5 newsletters that I'm going to target and spend money
You
with.
mean advertise on a newsletter?
Okay. Like an email newsletter. So we can sponsor a newsletter or something like that. And it's pretty affordable. Like the Joe Fairless one, they have like 40, 50,000 subscribers, and I can run a webinar promotion for $4,000.
Okay.
And he said they'll guarantee 200 registrations. On average, 50 people show up. So I spend $4,000 to get 50 people on a webinar on something they haven't seen. I know we'll close one deal, so that would be worth it to me, right? So that's kind of how I'm thinking about it.
I like it.
What makes your oil and gas your unicorn? What's special about it?
I mean, most people aren't allocated to oil and gas, right? It's different, and our oil and gas in particular is definitely more institutional quality. So it's not kind of mom and pop. Our acquisitions might be 600 or 700 wells, so that's a really diverse offering, and it's heavy cash flow. I mean, our fund 6 in the first year is paying 15% on cash on cash.
Wow.
So it's a really high yield investment offering with a big opportunity for upside. So our projected IRR is 35%. So most people just don't have the opportunity to invest in something like that. So I think that's what makes it stand out. And most of our investors are real estate people, so they don't have any allocation to oil and gas or energy. Right. So that's a big reason.
That's great to hear that you guys are doing well. Just meeting on the passive investor side, I'm just constantly blasted. As of the last 6 months, it seems like every mom and pop oil and gas fund is looking for investors.
Yeah, it's true.
It's pretty obvious.
Yeah.
A lot of capital raising in that area. But it's kind of hard to parse which ones are legit and which ones are just like, shot in the dark.
Yeah. I do see a lot. It's interesting that we're running ads and because to me, like I actually tell Facebook, I'm like, hit me with everything.
I gotta say this, the ones that get on YouTube and like get on site with the guy on the hard hat and the oil's coming up, and you're like, okay, you got my attention.
Yeah, it's pretty good.
Entertaining.
Yeah.
And there's something about video.
Well, I mean, acquisition times attention, right? Is like you got to figure out how you get attention. I can't get Ben with a hard hat yet out there. We don't. I'm not saying it's not good, but I don't have a good vendor to spend money on YouTube at the moment. So typically do Facebook.
You guys run ads in-house, or do you have
We have a team.
agency
We have an agency.
Okay.
I'm happy to recommend. They're pretty good if you want to run ads on Facebook. But again, most of you shouldn't, right? That's the reality. But they're good if you do. I think the thing I've learned too with Facebook is we also have a call team. So this was a company I built before moving to Aspen. Is I built a virtual call team to everyone who came in. I can look at our numbers today. So I measure on our Facebook funnel. I can show you our metrics. Like I think about it top down. So cost of acquisition, cost per meeting booked, cost per meeting held, and then so those are important, right? How much did we book? How much it costs us for someone to actually book a meeting, and how much does it actually cost us to hold that meeting, and then how much does it cost to close the investor, right? So those are pretty much. Okay, cool. I'll wrap up real quick. And I would just say all of our meetings get booked direct outreach. Nothing ever happens in a funnel. So it's a lot of direct outreach.
Yeah.
Can I email you to get those steps?
Yeah. Yeah. Any question? I hate that we're out of time. I would just say here's what I would just say. If you're doing something cool in acquisition, I'd love to know about it because I'd love to learn and make it better. Brainstorm with you, probably copy, and I'll do the same. Like, so if you have good ideas or things are working, like let's share that with each other.
My main thing is exploring Facebook and other social media channels.
Yeah. I would say in your case, man, I would not go Facebook. I think newsletters is a good idea. I think LinkedIn, I was just hearing about, there's 2 guys here that are doing LinkedIn and doing very well. And if you got a good avatar and you can kind of market at the right time, it's cheap, man, because LinkedIn is free and then you hire VA. So you're like, Rob told me, or not Rob, Sam told me he acquired like 60 to 80 investors last year through LinkedIn.
Yeah, I'll leave it.
No, messaging. Messaging. Direct messaging people who were changing jobs and kind of hitting them at the right time.
I get them all.
Hey, I just saw you change your job. Did you know that, you can kind of better allocate your 401k into alternative investments? Here's a video that I just put together. Check it out. So,
Catching them at whatever.